Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
How much is expected? Talking about volatility again. Why volatility is a great place to go to learn more about volatility. And also, the IAC, we give a lot of classes on volatility, so please come back and learn more about volatility. It's very, very important. Variance as measured by volatility. It's the error factor from the means. Lots of ways to look at risk. One might be standard deviation. We look at the movements being 1 and 2 standard deviations, or of course greater. Could be 3 standard deviations, and so on. Risk and reward remain in balance. So if I'm trading the Brazilian real, in your heart of hearts, you got to know that that currency, the currency pair, is riskier than, let's say, the U.S. dollar against the Canadian dollar. Why? The Brazilian real is perceived to have greater opportunities than the Canadian dollar, at least right now, as measured by the implied volatilities. The option premiums are higher. So the options market thinks that the real will be more volatile than the Canadian dollar. Is that a guarantee? Absolutely not. In fact, maybe that creates a trading opportunity if you didn't believe that. But that's what the option premiums do, and that's how, I call it a market call. It allows you, the investor, to understand what the market's looking at, and if you have a different view of the market, well, that might create a trading opportunity for you. The option Greeks are applicable for FX options. The major difference between equity options and FX options is the interest rate differential for the two unique currencies. And of course, we have to use the appropriate vol. So delta, and I'm going to talk more about this in the future in another class, the Greek class, but I wanted all of you to learn a little bit about the Greeks today. Delta is going to measure how much my option is going to change based on the underlier. So high delta options are going to cost more. They're going to move a lot more like a currency pair. Another part of the options, and of course the deltas go anywhere from decimals of almost near 0 down up to almost 1 or 100%. So you can look at it in percentage. If this option is at the money, that means that the option is about a 50-50 proposition. You might see far out of the money options have a 10 delta. Far in the money options might have a 90 delta. Gamma is going to tell me how quickly my delta changes. Because remember, this delta does not stay constant. In fact, it's going to change through the life of the option. So a delta of 52, 1 unit change with a gamma of 7, you just add the two together and say, okay, the old delta was 52. We have the gamma of 7, so the new delta is going to be 59. Theta measures time decay. An option closes at 350 with a negative 20-cent theta, and the pair opens unchanged, and next day, at least the theoretical value will be 330 or down 20 cents. Vega measures the risk of being long or short an option based on volatility. Volatility, or the expected move, is going to change every day. Excuse me. So I might see that if an option had a vega of 0.25 and the theoretical value is 250, if the vol went up 1 unit the next day, the new theoretical value would be 275. Of course, it could move down by that same 25 cents. And rho measures interest rates. Interest rates are important. But today, when rates are so close to 0, it's hard to really understand exactly how much influence those interest rates have, because if we're looking at rates of 0.5, 0.75, 1%, it's not a large influence. But if I had a 1% interest rate change, and again, you might think that'll never happen, but you know what? when interest rates start to get close to, let's say, 8, 9, 10%, you might see central banks move in 1% moves, or at least 0.5%. So a 1% move given a 6-cent row would mean that long calls and short puts are a positive row. So the puts and calls are going to have an inverse relationship there, depending on which currency the rates move up and which one moves down. So the interest rate differential is extremely important. The appropriate risk-free rates must be used when calculating the values. So rates do move. So depending on, again, the time frame, but I took this screenshot just a month or so ago. UK, US, Canada, Euro, Japan, Australia. So we've seen significant shifts in rates. We saw, a 5% change in the UK, 4.25% in the United States, about a 4% in Canada, 3% in Europe. Japan's rates haven't changed all that much, and Australia about a 3% change. Global interest rates, U.S. Fed funds rate obviously moved from 5.25% to 0. You could look at it in different time frames. What I like, if you look down at the corner, the bottom quadrant there, the major countries' policy interest rates, you'll see that they've all been declining, but the one that declines the most, based on currencies, might actually cause their currency to devalue a bit. There are a lot of factors that move currencies, so it's not just the interest rate differential, but it is a key factor. So volatility is stated in annualized percentage terms, one standard deviation up or down. Very powerful way of conveying the uncertainty in the forecast. So the option sensitivity to volatility is beta, and we talk about it from 1 unit change. I can look at historic volatility, and all historic volatility really does is that it looks at, in terms of the currencies, it looks at the currency pair value and how much did that actually move. So the currency, the sort of, if you will, the currency value, that AUM, how much is it moving? 87.94, 87.91, or 87.88. The lower range would give you a lower volatility. You can calculate standard deviations. Standard deviation is a mathematical term for risk. And the distribution curve graphically, I showed you some of that with women's heights, and then I tried to explain how that works with the currencies. But greater distribution would mean higher option premiums. For example, Brazilian real premiums are going to be higher probably than the British pound because there is more risk perceived in that currency. Risk goes both ways, though. So it's not just risk that it could move down, but it might move significantly higher. So that's what you need to think about when you're trading options. Reverse engineering of the Black-Scholes or the Garmin-Colehagen option pricing model or similar models. Instead of solving for the option's value, we use the market price and solve for implied volatility. The assumption is that the market participants are more knowledgeable in past data, and many experts believe implied volatility is the best predictor for future volatility. So all implied volatility really is that I could go, for instance, you can go to the AUM. We just stopped trading just an hour ago, and you might look at the front month, the 89 puts, and I believe that they are, I forget where the volatility is, but probably in the 11% range or something like that. You could get the implied vol of that strike price. And how do we do that? Well, we get the last trade from the options market, and then we can solve for what volatility makes that price fair. And that's how it works.
Thank you for participating in this week's session. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.